What are firms most underprepared for?
Geopolitical volatility. Every day there's sort of changes of direction from all sorts of governments.
Overconfidence in the completeness of your controls is a kind of a bad place to be. I think a kind of healthy skepticism is a good thing for a compliance officer to wake up with on that Monday morning.
That deregulatory moment we're in is an opportunity to try and help shape a future that's pragmatic and effective. And the only way you can really achieve that is if firms and the regulator work together on that.
I kind of like the idea of common interests and common goals.
If you can work in partnership, if you just stand on the sidelines saying slash this, cut that, etc., we'll just end up with history repeating itself.
Is compliance actually preventing misconduct, or is it just documenting it better after the fact?
I think it's a bit like the question about the French Revolution and its effect. It's too early to know.
If we think about compliance as just something which is there to prevent misconduct, we're already going off down the wrong track. The role of compliance is to drive good, sustainable business over the long term.
Stephen, Tracy, thank you for joining me. Thank you for doing this. I thought we could talk about risk and the market and regulator temperature over the course of 2026. And we've had a couple of enforcements happen around insider trading, and that seems like a natural place to kick off. So what do those enforcements tell you? And maybe I'll start with you, Tracy, if that's okay. What do those enforcement notices tell you about the way the regulator might be thinking about 2026?
Thanks, Dean. I guess what probably the key takeaway is if you look at those enforcements, you see that there is still a real focus on the part of the regulator on market misconduct, whether that be insider dealing, market manipulation. One of the interesting things I thought in one of those recent cases was there was actually a mention specifically in the final notice about the fact that the original tip had come from a store which had been filed by a firm. And that's something which I know firms have been asking for a long time. How do we know whether what we're producing is useful or not? So I thought that was really interesting that the FCA was highlighting that. So I think what I take away from it is there's still a focus on this. Market misconduct has not gone away as a topic of real interest to the regulators. And secondly, they're really trying to emphasize that this is a partnership, that actually firms have a really important role to play here, which on the positive side is encouraging. On the sort of perhaps slightly more challenging side is, if your systems and controls aren't in place, if you haven't got the right tools, then they will be coming after firms to say, actually, if you don't do this, we can't take this sort of action. So I think it's got quite a few messages in there, even though the actual underlying facts are age old, exactly the same as many, many previous cases.
You mentioned the word, I'll come to you in a second, Stephen, but you mentioned the word partnership, which is interesting. Do you think that it's clear that the regulator is looking for a partnership with firms? Do you think that the firms get that, and are they moving in that direction?
I think it's a bit cyclical, to be honest. I think everybody recognises that on things like tackling market misconduct, tackling financial crime, core consumer protection fraud issues, everybody recognises that the regulator and firms are generally on the same side. But over the cycle, you will feel whether it's more of a adversarial relationship or more of a partnership relationship, and that might be over the cycle within a particular firm depending on where it is in its own evolution, or it might be over the cycle with the industry, where if you have a sort of whole series of missteps by firms, the relationship changes very much to a bit more kind of teacher child or parent child.
Your view?
I endorse Tracy's observations. One of the things that's interested me about some of the market misconduct cases in the last quarter or half year has been the fact that the FCA has cast the net a little more widely and encouraged people to think about not just information in the secondary market, but the responsibilities of people in the primary market and of listed companies and the directors of listed companies. And I think it's important from the point of view of, for instance, surveillance and monitoring for regulated firms and indeed listed firms to think a little more widely about how information enters the market, and to remember that the market abuse regime in the UK applies more or less across any source of relevant information. It doesn't have to be, the broker who's got a tip, or the fact that you're talking to an analyst who's going to publish. It can actually be from the company itself, and are you looking for that? So I thought that was an important.
I think the other interesting thing, actually, just building on that, because obviously one of the cases concerns people who are, outside the regulated firm, but where you look at the phone or messages around there where it's saying, oh, have you got a brokerage account? Do you ever trade any shares? So one mate to his other mate, and then saying, oh, maybe you should open one. And obviously that makes it quite easy for the person filing the STR. You open your account on day one, and within days you're trading right ahead of an announcement. You're either incredibly lucky or you're on the receipt of inside information. But it is interesting how it is that sort of the amount of information that the regulators can get from the various communication mechanisms that firms will be monitoring within firms or retaining within firms.
You mentioned it's cyclical. Can you explain what you mean by that?
So I think we see, well, if I take it first from the individual firm level, so individual firms will have a period where they're in sort of steady state. Then quite often something will go wrong, or something will go wrong across the industry where they think, oh, we've got a big exposure or potential exposure in that area, and they start digging and they realise they've got a problem, and you might have an enforcement investigation or a Section 166 being done by the supervisor or whatever. So everybody's focus is on remediation. The regulators kind of got their eyes on us. The regulator asks the question, they say jump, we say how, et cetera, et cetera. The board's behind it, the money's behind it, all these sorts of things. So there's a sort of cycle there where sort of compliance, and actually that makes it less of a partnership relationship and much more of a kind of, we're doing this because we've got to get ourselves out of trouble. And then time goes past, memories fade, people get a bit more relaxed. The external environment becomes, as at the moment, there's a lot of deregulatory zeal about, and people are, the regulators, what do they want? So it starts being a little bit of pushing back on what's all this nonsense for, and so on. And then you have a sort of other phases of the cycle where, for instance, if you think about the sort of financial crime space, you actually find something that's really bad misconduct, and actually your teams feel great about that, actually, that they've sort of they can take a bad guy out of the system. And that's where you get that real kind of partnership and engagement, where you can see people saying, okay, we've done something worth doing for society. So I think it goes through a cycle depending on where you are in that. And then, as I said, the external environment also impacts that, because if you're having a crackdown, obviously the most recent big one was the SEC and off-channel communications. All of a sudden, everybody is like, oh, blimey, I better look at how well we're maintaining this. How good are our systems and controls? How good is our training on this? And there, I think people are seeking to partner, but doing it perhaps with an element of fear about, how do you kind of engage with the regulator on this to have a kind of constructive, open, adult dialogue about the challenges of doing that without opening yourself up to enforcement action.
Feels that maybe partnership is the way to move from what Tracey's describing, which is reactive. By the market, something happens, someone gets a fine over there, and all of a sudden everyone's scrambling to investigate what they can do about it. Do you see it that way? Do you think partnership is the key to avoiding that reactive approach?
Well, I think there's always an element of reactive approach, because no firm, and indeed no official sector body, has a kind of anywhere near a perfect view on what's going to happen next. So on all sides of the industry, there's always an element of, gosh, that's happened, what are we going to do about it? So the reactive is always there. I very much endorse the point that the thing is cyclical, and in any cyclical process, you have people who are at the front edge, people who are in the pack, possibly because they're designing themselves to be in the pack, because they think it's safe. And then you've got the ones who are trailing behind. And I think that the regulators, understandably, will be looking at the composition of all three of those areas. Why are particular firms either taking a particular step in the markets or changing their controls in a particular way, perhaps reducing their controls in a particular way? Why are some firms seeking safety in numbers, and is that a wise choice? Is the pack a safe place to be? Because sometimes it's not. And then they'll be looking at the people who haven't caught up yet and wondering whether that's clever and wise or the opposite of clever and wise, because people just haven't noticed that things are changing. I think I'd also make an observation, like a slightly bigger picture observation about the cyclical thing, and that is that we are now, 15 years on from the last days of the financial crisis, the great financial crisis. And there we went through a post-crisis situation in which practically everybody in the official sector across all of the G20 countries and in practically all of the main firms and industry bodies, everybody was on the same page. And they might disagree about the details, of the way that the legislative packages will be laid out. But actually, everybody was on the same page in terms of we have to make the system safer. We have to make it safer in terms of comms. We have to make it safer in terms of things like margin. We have to make it safer in terms of which things are on an exchange or a clearinghouse and which aren't. And there might have been difference in detail, but everybody was on that page. I think here we are now, and we are not only coming off that regulatory wave, but we're also seeing a lot of fragmentation in terms of where we go after that. So there is no longer a consensus, and you can see this in the regulation of the digital space. There is no longer a consensus about, if we do need to regulate, what are the right regulatory tools. So we've moved out of it in that sense as well.
I'm going to come back to partnership, because I personally think, from conversations I've had recently with the FCA, that partnership could be a key element of 2026 in the way that the FCA starts talking about certain things with firms. And I wonder whether you talked about safety in numbers, which has always been the case. Whether or not it actually works, I think most banks would take the view, well, if they're using it, I'll use it, and that gives me safety in numbers. Is there safety in partnership?
In terms of partnership with the regulator?
Yes.
I think yes, to a point. So I guess you have to remember that the job of the regulator and the job of the regulated firms are different, and it's really important for the regulator to avoid capture or the perception of regulatory capture. So there's always going to be a limit to how much of a equal partnership this can be, because the regulator has a job to do, which is something that has to kind of maintain that degree of objectivity and separation. But within that, I think there are huge opportunities for firms to work in partnership with the regulator for the benefit of the regulator and the benefit of firms, and more importantly for the benefit of market users and consumers. And I think in a world where you have two things going on that we've got at the moment, I think it makes it even more important. One of those is the speed of innovation. So, whether that be AI, whether it be other forms of tech, whether it be different sorts of products, consumer expectations have changed about speed, the ability to do things at speed has changed, and that's presenting a whole bunch of new problems for firms and for regulators. And the best way to try and tackle that joint challenge is together, to sort of understand what are the new challenges, what are just the old challenges in slightly different clothing, and so on. And how can you think about that? Now, in order to do that effectively, you do either have to be at the proactive end, i.e., we want to have this conversation with you now because we're seeing this, or we're seeing somebody going off doing this, and we're really surprised they're doing that. What do you think about it? So you have to be at the proactive end, because you can't be, oh, we're in the middle of the mess, can you please help us out of it? Or you have to have just come out of, we've just had the mess and we've learned all these things and we now need to sort of help shape the remediation. So that innovation and speed is the first thing that's changed, that makes partnership important. The second thing, I think, is the sort of deregulation push that I talked about, because that is a massive opportunity for firms. Stephen said earlier, we were all aligned post-financial crisis on what needed to be done, but I think everybody would accept that, when you do a lot of things at pace, some of them will have been more effective than others, some will work together better than others. So there is a real opportunity to take a step back and say, do we remember what risk we were regulating for? And is this thing actually effective to deal with that? And is that still the same risk today? And are we missing something because it's not within our current bandwidth? But the reality is that all too often phases of deregulation are followed by phases of re-regulation, because we don't do this in a smart way. We just say, if we are firms, we say, oh, slash all that red tape, get rid of all that stuff. If we're the regulator, we kind of react to that and get rid of random rules or whatever. We don't take the time to sort of step back and say, what are we actually trying to achieve here collectively, and what would be the best way of achieving that outcome in the most effective way at the most minimal cost. And the only way you can really achieve that is if firms and the regulator work together on that. So that deregulatory moment we're in is an opportunity to try and help shape a future that's pragmatic and effective, if you can work in partnership. If you just stand on the sidelines saying slash this, cut that, etc., we'll just end up with history repeating itself, and we'll get rid of some stuff and then we'll bring it back in again in different guises over the coming years.
Would you like to add anything to that? I've got a question for you if you don't.
So I think there may be a problem with the term partnership on both sides of the industry. As Tracey said, there is a perceived problem that the official sector can be seen to be captured by the industry, which of course doesn't work for their need to be independent. But I think there's also a risk that firms are or perceived to be captured by the official agenda. And it can be awkward, I think, in boardrooms to say we're following along with the regulator instead of, well, we're figuring out what we want to do commercially and we're working alongside the regulator, which is a subtle but important difference. So partnership can have different meanings. I kind of like the idea of common interests and common goals. And I think, and partly refers to Tracey's point, if the industry on the one hand and the official sector on the other can think about the risks that are in there and think, actually, unrestrained risks and undiagnosed risks are not any good for anybody, because you can't make sustainable profit out of undiagnosed, uncaptured risk. You need to look at the risk, weigh it up, think we can afford this much of it. We don't like that aspect of it. We price it in this way, which is what it's all about, is effectively pricing the risk where the risk is acceptable. And that sort of commonality of risk understanding, I think, is a better way to think about it, because partnership as a word, rather than a concept, has got some problems on both sides.
So coming back to reactive and cyclical, former Chief Compliance Officer Stephen Sanders, if you were to put your Chief Compliance hat back on and imagine you were back in the thick of it at a bank, in that role, these cases happen on Friday, you hear about these enforcement cases, what's your immediate action on Monday morning?
I think the immediate reaction should be, hopefully would be, okay, initially relief that it wasn't us, because there's always an element of that. And then rather more seriously, there's sort of two aspects to it. One is, what data have I got that would tell me how likely that might be to happen in my space? And then what controls have I got that ought to have raised the issue, avoided the issue, mitigated the issue? So I think you're looking at the toolkits for knowing whether it could have happened to you, and toolkits for knowing how you might have controlled it if it had hit you. And then, in my experience, you nearly always come away on the basis of that with something you can learn. Sometimes it's actually quite small that, that policy, it covers A, B, and C, but I don't think it covers D very well. So we should smarten up that policy. And sometimes it's wow, they weren't monitoring that at all. Do you know what? We've never monitored that, because you really don't monitor everything all the time, and so pretty much you come out of the general enforcement cycle on a regular basis thinking we should be looking at that.
That's really fascinating. Would you view it the same way?
Definitely view it the same way. The only thing I would add is there's also an opportunity to think about whether, from a second line perspective, whether this is an opportunity for you to reinforce some messages with the first line.
Yeah.
Because there's no better learning tool for first line traders, markets, business people than saying, look, guys, you're reading this in the FT.
Yeah.
This is why we keep banging on about this stuff. This is what this looks like in practice. And, just make sure you understand what the rules are.
Yeah.
Make sure you understand what is and isn't permissible. And, come and ask us some questions if you need to. So I think using kind of real life cases, I mean, the best possible examples you can use to help train colleagues is always something that's actually happened in your firm, because it really is real and tangible. But the next best thing is these, public cases, because you can have that sort of discussion. And, particularly, I mean, that the recent cases are in pretty well established territory in terms of the misconduct. But sometimes stuff comes out that is a bit new. And again, refer to the off-channel communication. Some of that was theoretically had always been around, but it was very much a new focus. The discussion that can prompt with your business people is a very different conversation to me or Stephen coming along as a chief compliance officer saying, oh, we need to keep these records. We need to keep these records. There's requirements. And everybody's like, oh, yeah, there they go again. But actually, so using enforcement activity or even supervisory activity as a tool to translate the regulators, and maybe partnership's the wrong word, but it's another way that you can partner with the regulators. The regulators' intent here, the reason we do all of this stuff, is to try and prevent or catch this. So bringing it to life is really important, because it's one of the most difficult things as a compliance officer you have to do, is get people to focus exactly the point Stephen made earlier. What is the underlying risk or issue we're actually trying to solve here, as opposed to what is the process we're following here?
So in a way, it's the regulator firing a shot across the bow of the market to say, make sure you've got your stuff together. Because if I'm a regulator, I'd be thinking, well, you should be monitoring for this stuff anyway. This is insider trading. Why are you only looking for gaps when we fire a shot across the bow? But maybe that's just human nature, and maybe those fires just need to be periodically shot.
Yeah, well, I mean, I think that it's hard to imagine any surveillance system or any monitoring system ever being 100 or more than 100% complete. And back to a point that Tracey made earlier, with the rate of change which continues and accelerates in the market, there is always a change in a product shape, a change in a market usage, a change in market language, in product features that you thought you'd got, but somehow went through the net.
Interesting.
And I think, the off-channel comms enforcements that over a sort of year and a half's period over the last couple of years, they drew a lot of attention to stuff that I think people had assumed might have been caught in the net, but nobody had really ever looked to see whether it was in the net and exactly how big the net was, to continue the analogy, and were the right things in there. So, I think overconfidence in the completeness of your controls is a kind of a bad place to be. A healthy skepticism around what haven't I thought of, and what are other cases going to teach me about what I might look for. I think that kind of healthy skepticism is a good thing for a compliance officer to wake up with on that Monday morning you referred to.
I think the other thing I would just add to that is, so yes, monitoring for insider dealing, every firm is doing some of that monitoring, but what real life cases sort of tell you is just it's a reminder, and you might look at your controls and think, actually, yeah, we're pretty well covered for this. But what's always interesting in cases, and enforcement notices are legalistic, they're written in a particular way, but they do give you a sense of kind of the human interactions that are behind these things, and there's often a behavioral signal, so you'll kind of see, oh, this person had who's done this bad thing had actually had a history of not doing their training on time, or not completing certain compulsory requirements, or had started leaving the office early or coming in late, or was looking around for another job, or whatever it is, and you kind of start to see and each of those things are individual, but I think it's always a really useful reminder of, and again, this is not something that is just for the sort of compliance team to look at, this is actually the people supervising on the ground. It's very rare, in my experience, both from a regulatory enforcement perspective and internally when we looked at internal misconduct when I was at the bank, it's very rare that you get somebody coming through who's a complete clean skin, who nothing has ever gone wrong ever before in their sort of interaction. There may all be lots of little minor things, but they usually are signs. And I think one of the challenges is always, how do you kind of look at those signs? How do you think about, is there something they can do to inform how you think about your controls, how you think about your monitoring? Is there something that's an indicator that you should be monitoring more broadly to see if it's, because it's a leading indicator for misconduct risk rather than a lagging, which is what most of them are.
Yeah, and if I can add to that, over the period of the last year, there have been a couple of specific cases where, to some extent, the regulator has said, well done, you saw this, but you never connected it to that thing over there for which you had the data. And I think regulators are getting more joined up themselves. If you look at the amount of information that regulators are now accessing and the toolkits that they are using, they are now much better at surveilling the data they receive than they ever were. And they are getting very smart around, well, you could see that. Did you not think to wonder whether it was connected? And does your MI and your monitoring or surveillance information just go vertically, or do you ever turn it the other way and say, to Tracey's point, these things might be cropping up in different silos, and if you connected the silos, you might have seen it earlier. So I think that is that's a timely thing for the way the industry thinks about risks, because at the moment, it looks to me as though the regulator is on the front foot in its understanding of the connectivity between issues, and some firms that one sees are not on the front foot in terms of connecting things that they have. And that's the point. You've got the data, because firms do collect colossal amounts of data. Now, query, how good are the firms at turning it around the other way and saying, I wonder if these things have got a horizontal connection?
That's something that potentially technology can solve.
Yeah.
Really interestingly. Tracey, what are firms most underprepared for in 2026? I'll make it easy for you. Pick one thing that you think firms are most underprepared for in 2026.
Difficult to answer the question, because if I really knew what firms were underprepared for, everybody would be prepared for it. But I guess I would say the amount of volatility out there, and I don't mean market volatility, although that's a part of it, but I mean the sort of geopolitical volatility. Every day there's sort of changes of direction from all sorts of governments. There's a lot of activity going on in the space of regulation, deregulation. we talked earlier about fragmentation. We're seeing much more divergence, and I think trying to, as you're sitting in a firm, think about what are the potential risks that this volatile environment brings to us, that maybe are not, they're not ones that are looming in my face, but they might be around the corner tomorrow. So I think that, how do you think forward around potential scenarios that play out? So what happens if the US and China impose particular sets of sanctions on each other? What does that mean for us from a risk perspective? What about if India introduces even more restrictive data protection laws? What does that mean for us if we've got lots of back office in India? So I think it's thinking from a compliance officer's perspective much more broadly than perhaps you would have had to in the past, because you're not just thinking about the rule book and understanding the business. You're also trying to think about what are those big shifts that might happen, that might impact on us in terms of our business and our ability to comply. And I think the reason that's a bigger risk for 26 is just because it's so volatile at the moment that it's much more difficult to predict, and the timescales in which things are happening are much quicker. So you've got to be able to react to them.
Same question to you. I know it's a difficult one. It is practically impossible to answer, but that's what makes it an interesting question.
So I think the macro instability that Tracey cites is definitely the big story. And just to amplify a particular point from that, I don't think compliance officers are, by nature or by training, necessarily accustomed to thinking in that space. They are very good, and in many cases have got excellent training around a particular space, which is inward looking in terms of controls and risk profile. So I think that can be a particular challenge. But to add an additional part to this challenge, I would cite the difficulty that I see with people in risk and compliance trying to get their heads adequately around the technology that they depend upon and be fully accountable for what that technology delivers or doesn't deliver in terms of their controls and oversight. And again, most compliance officers, and I'd include myself in this, are neither by training nor inclination technology skilled. Yet we are, as an industry, and certainly as a discipline in compliance, forever more dependent upon increasingly complex and often third party, which is a point, it might be quite a long supply chain to the person who's actually delivering that sanctions filter for you. So we're on these increasingly complicated technological supply chains. We may not understand the technology fully, and we may not understand the chain of dependency, reliability, and output that goes down that supply chain. And yet, unsurprisingly, the regulators will expect us to. If they come in for a supervisory visit and they will say, okay, so I see that in this particular area, I don't know, AML controls, you have internal outsourcing within the group to another jurisdiction. You have over here external outsourcing, you have a third-party supplier, you have a technology platform and an intermediate technology platform that interfaces with yours. Walk me through the governance and oversight that ensures that the inputs and outputs are working in terms of risk management and control. And I think as that technology gets more complex and advanced, and as the supply chain relationships get more complicated, and we've seen obviously enactments in many jurisdictions in the last couple of years, for instance DORA in the European Union, saying how are you tracing and how are you relying upon these people and what assurance do you have? I think those things combined are a huge challenge for compliance departments.
Yeah, I think the regulators have recently been quite critical about what they termed custody of these systems. I'm not sure what the solution is from the bank's point of view. Is it? Do you think the problem's about budget, incentives, ownership? How do you solve that?
So I think one of the very practical challenges, I think, is you're often dealing with people in your supply chain who are not regulated and are not used to being regulated. And part of the reason you're using them is because they're doing cool, innovative stuff, using cutting edge technology and so on. And then you say, oh, right, well, actually, can you fill in this sort of 45-page questionnaire that tells me, exactly what you're going to do in the event of a sort of power outage, and what your backup system is, and where your data is, and all of these things. And actually, that's quite a big burden on your suppliers. It's also quite a big burden on the firm. It's a source of incredible internal tension, typically between the kind of compliance or risk people and the kind of person who's trying to procure this service because they think there's this great person out there. And I think so I don't think it's really about budget, although obviously money is always an issue, and the more work you've got to do, the more challenging it is. But it is about how do you see through that complexity, and how do you see, okay, this supplier is actually relying on somebody else, and how far you go down into that chain. And it's a new thing that we're all doing, and I think it's a thing that I think it's right that the regulators are focused on it, because I think all of us run the risk that there is a blind spot in terms of potentially systemic but certainly important reliance somewhere in the system on something that's completely outside the regulatory framework, that if it goes down, we'll suddenly all discover, oh, actually, 25 of the biggest firms were all relying on this thing, and now we're all out for 6 hours. And that could be a really big deal. So I don't think it's... So I think the challenge, to specific your question, I think it's culturally very different from what we've done in the past. I think you then have this challenge between you're trying to do things with a provider who's not used to doing it, and you're trying to kind of have, here's a banking regulatory conversation and here's a technology conversation, and they don't always go across. And I think there's these potential blind spots that we could miss.
And if those blind spots are being missed now with legacy systems, what happens when everything starts to become AI powered?
Well, I think AI as a whole is a risk we could talk about in itself. I mean, obviously massive opportunity as well, but the potential for where that goes, the opportunities there, both from a commercial and business perspective, but also from a compliance perspective, are obviously huge. But almost by definition, AI systems are much less easy to understand if you're not a technologist in terms of how they work. AI is embedded into so many things. Give an example here. So, when I was at Standard Chartered, we had a process for onboarding AI tools that went through using the sort of Singaporean MAS system of fairness, ethics, accountability, and transparency. So we had a checklist, for want of a better word, based around that. Say, okay, is this something we should do? So, whether you're installing AI in your HR systems or your finance systems or whatever. That's all very well when AI is one little novelty thing that you're doing here and there. But we were already finding, a couple of years ago when I had left, actually the system was great. It was a Rolls Royce, but actually it wasn't necessarily going to work at scale, so we needed to adapt it. If you then think every third-party supplier you're using has probably got AI embedded somewhere in the system, how do you understand that, get hold of that, and get yourself confident that actually it's AI that's working in a way that you would want it to, consistent with the values of the firm and the reputation of the firm?
Yeah.
I'll come to you with a question because you're looking at me blankly.
No, I violently agree.
Yeah, no,
there's
not a lot to follow up on that. It's a perfect answer. Thank you. I was going to move on to. I think this is an interesting question for you to start with. So today, other than AI, what feels harder, do you think, for firms to manage around their systems than maybe 3 to 5 years ago?
I think the most difficult thing is the widespread dependency on legacy systems that took a long time to put in place, are well embedded in the firm to the point of kind of almost blindness. You just assume that the legacy system will be there doing its thing, whether it's in surveillance or whether it's in, for instance, in settlement, but you take a feed off it because you're doing monitoring based on that. So these legacy systems are sitting there, and it can be really difficult, I think, particularly in compliance and risk, to pay enough attention to them and to demonstrate how you're ensuring that they still do a job that's worthwhile and that they're still delivering against the risk profile. And I think one sees some cases, I mean, you see it come out from time to time in enforcement, and you certainly see it in a supervisory context in my professional life. You see regulators saying to people, okay, so you've got huge dependence on this thing. How's it work? Does it still do the things that you set it up to do? Does it do things that are relevant today? Or is it really only relevant to the things you needed doing a decade ago? And bearing in mind what we said earlier in this discussion about the pace of change, there's kind of firms out there who are finding that the legacy systems that they have are just not fit for purpose. And they are poorly maintained, sort of neglected relatives, may not be doing awfully well the things they were originally set up to do. The things they're originally set up to do may not be completely relevant, and they're probably not doing any of the things that are really priorities given the change we've had in recent times. So I think staying on top of what's my legacy system infrastructure doing, and what ought it to be doing, and how do I update it? I think that's quite a problem. Again, without the expertise, in the necessarily in the compliance mindset, without the expertise, but certainly regulators I see challenging in that space, and compliance officers finding it quite difficult.
I would completely agree with that, and I would also add to that quite often those legacy systems have been adapted in ways over the years that hasn't been written down.
Yes.
And so you think you understand what they're going to do, and then when you decommission them to put in a new system, you suddenly realize they were doing something else as well.
Yeah.
And depending on what that something else is, that could be a big problem that manifests immediately, or a small problem that doesn't manifest for ages but actually ends up with you having incorrect client statements or something over an extended period. So those tweaks that have been made are really tricky. I think the only other thing I would add that's harder, and I think gets harder every single day, is cyber, and the cyber threat. And this is another example of where AI and things like quantum and stuff are terrifying in terms of what you can think about in the cybersecurity space. I think the profile of that has massively risen over the last few years. The awareness of that within the industry, but also within the official sector, and there's a lot of vigilance out there. But I think it's a battle that will never be won. And it is really one where the arms race keeps ramping up, and the criminals, the sort of cyber attackers, don't have to worry about procurement or third-party suppliers or DORA or where they're getting their stuff on the dark web and whether they've got a sort of ethical policy. So they can move really, really quickly. They can innovate really quickly, and actually you've got that potential tension between what you rely on in a regulated institution and fighting against something which is much more like guerrilla warfare.
Of those sorts of things, are there any that you look at and you go, I'd love to be a chief compliance officer again now. I'd love to tackle that one. Are there any of them that you look at? Or do you just think, thank God I'm not doing that anymore?
So I think I'm very glad I'm not a chief compliance officer anymore, but I'm very glad I'm not working full time anymore. So actually, it's not about being a chief compliance officer; it's just about different things. I think the thing that's really exciting in the compliance world at the moment is there is this real opportunity to move from being a sort of managing a process and managing an infrastructure to really thinking about how do you derive insights that help you manage your risk, that help you drive better behaviours, but also that give you real insights into how you can sort of develop the business and so on. And I think the opportunities, and again, sorry to keep using the cliche of AI, but the opportunities there to really mine all of the data that's held. Stephen mentioned this before, you've got all these massive silos of data, the opportunity to sort of think of ways you can bring that together and really work together with business colleagues to say, actually, how do we do a much better job of getting proactive, seeing things that are coming around next? I think that's a really, really exciting time. Very different form of compliance from 20 years ago, and it's been an evolution towards it. But that, I think, is the thing that's exciting.
Yeah. If I can add a thought on that, there's been some debate in industry fora over the last year or so about whether the 3 lines of defence model is still fit for purpose and whether it still means what we all sort of thought it did 20 years ago or whatever. And one of the issues I've been thinking about recently is that whether the types of technological challenge that Tracey was referring to will reshape the 3 lines of defence model. Because I mean, I hope we would all think that no concept is inviolable and lasts forever. It lasts through its utility, then it gets amended and changed. And in some ways, the 3 lines of defence model has stood us in good stead, and it's been a good, reliable framework. But I do think, in the same way that one can think about using information laterally, turning it round and looking for connections between these silos, we can also think about a redistribution and a different form of sharing of responsibilities in first and second line. It used to be the case that one of the ways in which information was siloed was that certain stuff was over there and it was distinctly first line, and you had to go and ask politely in the second line whether you could ever see it. Now we're in a situation where a lot of systems, and particularly the widespread use of AI creates what's essentially enterprise data. So you can see it in the first line, you can see it in the second line, you can say, are you seeing what I'm seeing in that particular flow? And I think it changes the possibilities of the way you structure first line and second line responsibilities. I'm not talking here about a loss of second line independence, but I'm talking about the way in which you can show custody and make use of data in a different way between first and second lines of defence, and potentially how both of those can feed the third line in a different way, because the information can flow in different ways, can be synthesized in different ways, and it may change and simplify some of those structures and responsibilities.
I think that's really interesting, because I had a question about the cat and mouse nature of AI, and if the threats become AI driven, whether the defense needs to become AI driven. But as I think about it, the answer to that question is kind of obvious, and the answer is probably yes. But what you're talking about, and it'd be great to get your view on this, Tracey, is actually a structural change from the traditional 3 lines of defense, maybe, is not being quite right for the new AI world.
I'm not sure it's just to do with AI, actually. I think there's lots of kind of questions and challenges that the 3 lines of defense model has generated. And, you find a lot of firms that have got a 1.5 line and a 2.5 line and a sort of second, third. So I think conceptually the model makes a lot of sense. In practice, there's a lot of blurring of the lines. And I think if you think about things like operations, so including technology, but also other aspects of operations, is that a first line function? Is that a second line function? It's not second line, but it's not really first line, because first line's business. But actually, a lot of the big risks we're talking about now within institutions are coming from the technology going wrong. So if you're a first line business owner, you're like, well, hang on a minute, I don't know whether the payment system works. That's the responsibility of somebody over there. So I think there's lots of challenges that are technology driven. I think AI just, as with many things with AI, just accelerates some of them, but does give this opportunity. And I think it's almost more about what persona are people occupying at a particular point in time, rather than a rigid structure. So I don't know. I don't think anybody's come up with a better model yet than the 3 lines of defense. There's been lots of commentary about whether it works or whether it doesn't work. But I think, when you think about the possibility to use tools to audit transactions in sort of real time much more effectively, you can kind of take the second line out of that process altogether, and then the third line just looks at the output of that. There's no point in doing this duplication. So I think it will evolve, but I think it's part of a more general blurring of the lines as different aspects of the organisation become more critical.
Yeah, if I can add a thought on that, I think we see this particularly, or will see it particularly, in terms of, for instance, market surveillance, in which the sorts of tools that are being developed now are equally useful and equally accessible, can be equally accessible in both first and second line roles. And that for me is the kind of the poster child for where you would think we don't need to do this task twice. As long as the questions are being asked and the right things are being escalated, you can have quite a lot of flexibility, and therefore quite a commercial approach to where the surveillance tool is placed and where the escalations go to.
I think also, just sort of on that point as well, where you think about sort of more real-time detection as well, and I guess the sort of most obvious place that this happens is in the fraud space, where actually most people have got really good real-time detection systems for potential fraud, and they and that's a growing threat, so you have to have that. But that means you can't rely on your traditional first, second, third line division in that sort of fraud monitoring space. It becomes a much more integrated exercise where you're reacting, and I think there's opportunities to do that in other areas, market surveillance, as you talked about, financial crime surveillance, and so on. So there's lots of opportunities to think a little bit more about how you can be much more in the moment as opposed to post hoc reviews, which has obviously been the traditional way we've all done this.
If any restructuring of the traditional three lines of defence is to take place, is that something that could naturally fall out of a partnership between firms and regulators that we were talking about earlier?
Well, certainly if the industry is moving in the direction of modifying yet further the three lines of defence model, it would be kind of unwise to do that without the regulator also being engaged in the discussion. Because I think regulators, for very good reasons, are pretty well invested in the sort of classical structure. As Tracey has mentioned, firms do it differently across the piece, and the regulators over time have come to understand that through a process of supervision, and they see different practices. But I think it's important for firms individually and the industry as a whole to make sure that they are in touch with the regulators and that the regulators are on board with the transition. So if, for instance, a particular firm would just to wake up one morning and say, hey, we've fired the third line, I think regulators would probably want to understand how that works. But I think the kind of the supervisory dialogue, particularly in the larger firms, which is a regular ongoing thing, supervisory dialogue says, this stuff we used to do in the second line, there's a really good way in which it can be done in operations, can be done in true first line, can be done in a space that's one LOD and a half. Then I think that's part of the continuing dialogue with regulators, and I think pretty much regulators are pretty receptive to that, because it shows intelligent life, as it were, going on in the firm in terms of, okay, we're thinking about this and we have a better mousetrap. What do you think of my better mousetrap?
Is it partnership or is it just better dialogue?
I'm not sure it matters in a sense what you call it. I think the kind of challenge, Stephen used the phrase earlier, there's areas of common interest. actually firms and regulators are aligned most of the time on most things in terms of what they want to achieve. So everybody wants, clean markets where you're delivering the right sort of products to your customers, people are kind of happy with what they're getting, where you've got a vibrant, innovative industry and you've got a sustainable income growth. So none of those things are controversial. The challenge is always around the kind of how and what do you need to do. If I think back to sort of my days as a regulator, one of the things that was always quite frustrating is any time you propose something new, you'd have the firm saying, "Oh, well, you can't possibly do that because the sky will fall, and if you do that, if you make that change, we've always done it this way, etc., etc. You will make UK PLC uncompetitive, etc., etc." So you then spend months and months having this slightly fruitless debate where one side's saying we must do this and the other side's saying you must not, and then in the end the regulator says, well, we're going to do it anyway because and then people start saying, oh right, it's really going to happen. Well, actually, if that's the outcome you want to achieve, maybe we should do it this way because we could make it much more effective and much less costly and so on. But by that stage you're almost so far down the line that you've lost that opportunity to really shape the sort of outcome. So I guess is that better dialogue? Is that partnership? Is that some form of collaboration? I don't know what the right term is, but it's really having a conversation which is much more focused on genuine understanding of the outcomes that you're trying to achieve on both sides of the fence. What is the best way to achieve those? And because firms know a lot more than the regulator does about what's actually going to be effective within a firm. They're the ones who run the things. They know how difficult it's going to be to implement or how easy it's going to be to implement. They know culturally whether it's going to be something you can kind of get buy-in for or not. So I think that's the sort of conversation you ideally want to be happening. It does happen sometimes, but it happens less often than it should. And I think that disadvantages firms as well, because it then means that you end up with a truncated timeline to implement something which might actually really impact your business strategy, whereas that earlier conversation and dialogue could potentially mean you could adopt this in a way which doesn't impact on your business strategy as negatively and so on. So I think it's that it's not just any old dialogue. It's a dialogue which is really based on trying to understand what it is, the outcome that's trying to be achieved, and therefore exploring the ways of achieving that, as opposed to just constantly talking at cross purposes about, no, that's the wrong question or the wrong answer.
And to be fair, the UK regulators, I think the FCA, have led the world in terms of, particularly if you think of things such as the regulatory sandbox. The FCA was the first major regulator to think about this technology is approaching. We could create a space in which firms don't have to feel afraid to show what they might do, in a space where nobody's going to get harmed. We can see how it all works. You can try out ideas. And that was actually a remarkable step for a regulator, and they were the first to do it. So I think that's a great example of the official sector, in that case, being in the lead to make a space where the industry and the official sector could cooperate together, could show partnership values together. And a lot of good has come out of that and similar measures. And that's fostered progress on both sides, I think.
Silos were mentioned earlier. I can't remember whether it was you, Tracey, or whether it was Stephen who was talking about silos, but regulators now expect integrated oversight across AML, fraud, cyber, sanctions, market abuse. Are firms structurally capable of that, do you think?
Are they structurally capable? I mean, they're obviously capable of doing it. Are they structurally set up to do that currently? No. Because historically, many of the things you just listed out there have sat within different, or almost all of them have sat within different teams. Many of them sat within different departments or divisions between compliance, risk, sometimes the first line and the second line. And actually the sort of process of how do you bring all of those things together is really challenging internally, partly because you'll have the inertia and cultural resistance to, I'm a specialist in X, I can't work with Y, partly because there is a genuine legitimate concern about, okay, if I start turning things off here because I'm relying on somebody over there to deliver them, what happens when they decide that's not their priority anymore? Or, Stephen talked earlier about systems that were designed to do one thing and then you start using them to do something else. What are the risks there? So there's some of it is the sort of, perhaps slightly less positive kind of protecting your own turf, but some of it is also genuine risk management questions about how do you make sure that you don't lose anything at the same time as you look to gain things. But I think firms are capable of doing it, but it's not necessarily a straightforward exercise. It's not as straightforward as it sounds to bring all these things together and just do it kind of across the board. So I think firms are starting to do it, and some firms are further advanced down that journey than others. And I think that's the way it will ultimately end up, because particularly as we get more data and cut across silos and so on. But I think it has to be done quite thoughtfully and quite carefully. And one of the challenges is that it will often require investment in order to do this. So it may be the better way to do it in the longer term, but there's probably going to be a short-term cost in whether that's a technology cost or a people-related cost from making those changes. So it's not something to embark upon lightly.
I agree with that, and I'd add an observation that you can now see quite a difference in the way that new firms are setting themselves up. So as you see firms setting up now and going forward for authorization or similar, they are setting themselves up technology first. And then the kind of nominal things that technology does in terms of like departmental titles or functions or whatever are labels that are then put on interfaces or products or outputs, rather than being, I'm this department and I've got a system that does this. You've got a platform on which the firm sets its whole offering and then actually puts the different output labels on the outside of that afterwards. And I think that is convenient for new firms coming along, which can build technology first up and go into the market on that basis. But I think the contrast illustrates the point that Tracey makes, that if you are deeply invested in established ways of doing things, and each part of that system has got its own, we said earlier, legacy systems and practices, it's really difficult to configure yourself whilst running your business as usual, by the way, and allowing for the change that's happening externally. Then to say, okay, by the way, we've got to completely configure how we do things to make more lateral connections across silos. It's a significant challenge.
And if I just add on that, so I think on the newer firms, technology first, that's absolutely right. A lot of people are sort of trying to build all of this stuff into the system from day one. I think actually, though, you've seen a number of those getting challenged when they grow, because actually the sort of fleet of foot, new tech, cool and happening fintech stuff, when you start scaling, has often become a problem. And that maybe become a problem because the business volume has run ahead of the technological capability, or it may be because there was something that you thought you could do manually as a workaround, which works fine at a certain level of your evolution, but doesn't, but kind of got lost along the way. And so we've seen, some of the newer firms fall down very publicly in relation to some of these areas, whether it be in the sort of capital area or in the financial crime areas. Has been public enforcement activity around that. So I think the concept of building in your risk management and compliance and surveillance systems to your stack at the beginning is there's a very good game talked, and actually some people I think do it really well. but it's certainly not flawless.
Yeah, absolutely.
There's a question in here that I can't quite frame right because I'm sort of out of my depth on the compliance side of it. I don't know whether you can help me get this question out, which is around, and I think I read this recently, the regulator was talking about stores, and you mentioned stores earlier, as being defensive rather than being business intelligence drivers within the business to help connect siloed dots. Sarah, there's an interesting question in there, I think. I just can't quite get it out.
It was in our discussion the other day.
Is that where
we
it
were
came
both
up?
talking about it? Yeah, because it came out of this thing that if we were better connected inside firms, we might actually be able to be better at filing stores that were really useful rather than just filing them, because there's a bit of a suspicion. I don't know how deep
It's
it is,
defensive.
but I'm gonna file it. You know, and the official sector often sort of says that they're inundated with suspicious activity reports and suspicious transaction reports that they can't get to. I mean, their capacity for getting to them will improve. But I think it was around that we were talking about this. And, you know, could we do everybody a favour if we were better at processing across silos and therefore knowing that it really was a substantive suspicion? I think that's what it was. Discussion.
Do you think we could?
So to this question of defensive filing versus useful intelligence has been a topic since since we started having the filing of SARS, and particularly in the financial crime space. And the challenge is that it is often easier and quicker and safer to just put the SAR in or put the store in or whatever, rather than doing the additional work to try and work out whether there's genuinely an issue. I think this is another area where, as we think forward to the sort of next generation of surveillance tools and monitoring tools, we will be seeing a different form of suspicious activity reporting, because we will be looking at, and we will be, people already are, looking at a whole bunch of indicators to identify what's suspicious versus what might just be unusual in a particular transaction. At the moment, we are, I think, in that sort of transition phase where the regulators still expect to see all of the things they saw before and are very worried about anybody turning off any legacy systems. In the financial crime space, you talk about no SAR left behind. So you have to show that your new system will not only produce lots of really good new stuff that's actually much more useful, but it also won't miss anything that you did before. So you have, even if you can say, well, look, actually, this scenario that I'm using in my old system only produces one hit in 1,000. It's really very inefficient. And my new system actually produces much better outputs, even though it might miss something. It's quite hard for a regulator to say, well, no, actually, it's all right to miss that one thing. But as I said, I think we're in that transition phase where we're moving away from this very sort of rules-based, sample-based surveillance monitoring activity to this much more dynamic, real-time, looking at lots of inputs, not just one, which will then present you already with something which is a much more intelligence-driven piece of filing, because it's richer and broader and looks across the piece. I think that's got to be the way to go. I think both from a sort of regulatory and law enforcement perspective of producing stuff that's actually really useful and really helpful, from a firm perspective in terms of helping them manage their risk and make sure they're not, inadvertently harboring bad guys either internally or as clients, and also in terms of effectiveness and efficiency. But as with anything where you're changing, particularly if you're talking about radical change, it's going to take time for both firms internally to get comfortable with it and regulators to get comfortable with it.
It's hard to see it as anything other than a radical change. That's the problem. It's normally with technology, you find you find your evolutionary path. You can take the regulator on a journey. We're going to do this and then this and then this and then this. With AI, it's actually so night and day, the shift. It's going to be quite challenging to find that evolutionary path. Do you think that the regulator, one of the things that you mentioned, Tracey, was a regulator view being having to become, I accept that in this new system, statistically, it's better, even though you might miss the odd thing that the legacy system detected. Do you think the regulator can make that leap?
So I think they can, but I think it needs to be. This is definitely an area where you need this sort of dialogue to sort of help understand what it is that what it is you're trying to do, how you're comfortable that it's actually producing those better outcomes, and I think recognizing that you might miss something that was unimportant in the sense of law enforcement didn't do anything with it anyway, or the regulator didn't do anything with it anyway, versus actually you're able to spot a pattern which could be an indicator of a sort of mule network, or it could be an indicator of an insider dealing ring, or whatever. I think you should be able to sort of get to that point, but it's the sort of automatic reaction from the regulator, and it's not surprising, is going to be, well, I'd like to have my cake and eat it, please. So please run all those old systems that you had that produced everything that you produced before, and then run this new stuff as well that's going to give me all this other good stuff, because then I lose nothing. But obviously from a firm's perspective, actually that adds an enormous amount of cost. It also adds an enormous amount of complexity because you're running two completely different systems. And actually when you're looking at the AI and behavioral stuff, it's such a different approach to thinking about monitoring and detection. It's almost impossible to really run them in parallel in a sensible way in the long term. So I think it's a lot of this is around making the regulator comfortable about what is the monitoring and testing you're doing before you roll out any of these systems. You might have a period of parallel run. You might be wanting to sort of give some information to sort of show actually this is better outcomes than here, and that you're doing it carefully and in a considered way. And I think that's always going to be the challenge. As you said, Dean, it's a big change. It's a radical shift in the way we're thinking about doing this, and people have to get their heads around that.
I think there's an onus on firms to get the regulator comfortable with the idea that they're getting a qualitative improvement, or at least no diminution in quality. And there is a reasonable amount of well-founded skepticism around some technology and some AI in particular. And one could hardly be surprised if regulators and others say, well, okay, not only do I want to eat my cake and have it, I'm going to stay that way until I know that the new approach is at least as good qualitatively. So I think firms need to think about how they show that the quality of risk management for the market, for the regulator, the quality of risk management is at least as good, which is kind of the threshold condition for letting go of the old stuff, and hopefully is better, which will then accelerate the acceptance more generally that new approaches work well. But I think the onus is there on the industry to show that qualitative equivalence and then improvement.
I think one other area is always as well, there's a kind of, we all take comfort from sort of human in the loop type scenarios that, there's a person looking at this alert. Actually, people make mistakes all the time. People are exercising judgment, and, they make a call and it actually turns out to be the wrong call. So you miss something or whatever. There's many ways in which actually having those things done technologically will enable you to have a much more consistent set of results. And you've sort of seen this with sanctions screening, right? There's sort of lots of use of machine learning and AI in that space. And once you've trained the model, it's actually much more reliable than a human being.
Machines always will be.
But it's taken a little bit of time to get people both within firms and within regulators comfortable with that idea. So I think sometimes we take false comfort from human involvement that will somehow make it a better product, but somebody has a bad day, they get distracted and then they make the wrong call. The machine yeah, the danger with machines obviously is if they make the wrong call once, they're probably making the same wrong call 1,000 times.
Yeah.
So you have the kind of scale problem.
Yeah.
But
Yeah.
actually, if you can calibrate it right, it's much
Yeah.
more reliable.
I'm very interested in this point because it's become, absolutely critical that in any conversation about technology, and particularly AI, somebody has to say, we've got to have a human in the loop. But I think there's a really important discussion around why and when. So, it's great to have a human in the loop on those things, to Tracey's point, where we know that a human can and must do a better job. And if, by analogy, I know nothing about medicine, but from what I read, clinicians have become really quite good at knowing that AI can spot certain pathologies, and it's much better than humans in certain spaces. But you're not yet at the stage where you actually want a machine doing some of the clinical work or some of the surgical work. So I think there's an onus when we're applying technology in this way to say, what are the tasks where a machine can process far more data, far more effectively than humans are ever going to? And then where is the critical point where an experienced human judgment is really going to make a difference? And distinguishing those cases really quite strongly when we lay out our stall internally and when we lay out our stall to regulators, not just say, oh, I've got a human in the loop. Is this the right job for a human? Is this the right job for technology? And are you making the case properly between the two?
And I think it links back actually to the conversation we had earlier about the 3 lines of defense, because that human in the loop is kind of a different form of the 3 lines of defense model. Because actually, if you're saying the machine can deal with the alerts, it doesn't actually need a human, potentially doesn't need a human in the loop to review the alert. But what it does need a human in the loop to is to make sure that the instructions that are being given to the machine are intelligent and are actually designed to solve the right problem. And then it needs a human in the loop to check that actually the output over time is continuing to produce the right things. But that can be a sort of sampling, auditing exercise as opposed to a hands-on exercise. So there's, again, different forms of evolution of the way we work.
It's fascinating to me. I'm seeing the inner chief compliance officer coming out of both of you, because you're taking what has unfortunately become a slogan and turning it into an operational control. And that's maybe something that is a theme for firms over 2026. It's not a slogan.
To apologise if you
but it's a great point. You're taking a slogan that's being thrown around left, right, and centre, and no one really knows what it is or where it goes or how it's applied. And you're saying we just need to turn it into an operational control.
Yeah, and decide whether it's the right operational control. And not just a slogan.
Is regulatory divergence accelerating in terms of EU versus UK versus US versus Asia? And what does that do to a global compliance strategy?
We talked earlier about the nature of cyclicality in regulation and in response to regulation. And we touched on the idea that, with the global financial crisis, we went through one great moment of unity. How do we respond? Most people, official sector and in the industry, on a similar page. These are the things we need to manage. These are good ways of managing them. We've come off of that part of the cycle, not only in terms of the deregulatory spirit, but in terms of the diversity of approach around the world. I would say that the role of the compliance officer who is trying to wrap their arms around a multi-jurisdictional control infrastructure has become much tougher than it was. One sees in practice a number of practical problems around the relative standards of controls. So, my group is controlled in country A. My group has branches and subsidiaries in countries X, Y, and Z. What's the appropriate standard? If I then branch out of the entity in country Z to another jurisdiction, what do? Do I take head office? Do I take local? Do I take regional? Do I take entity? Do I have to have so? So I think the divergence of approach has made practical complexity much greater for compliance officers operating across jurisdictions. I mean, I'm hopeful that on the positive side, technology can ease some of those strains, because one of the things that one sees in the types of system and approach that are now coming forward is that you can have, for instance, a base approach to monitoring, or a base approach to data capture, and then you can tweak your outputs by jurisdiction. So we're seeing a number of systems now which are allowing for that. And so technology can ease that, but my goodness, it needs to ease it, because I think regulatory divergence is proliferating. And, it's not just about black letter divergence, so that laws go in particular different directions and specific requirements are different. It's also about the temperature in jurisdictions and the temperature between jurisdictions. So if you're operating in a jurisdiction over here, which because of political circumstances requires its data to be in a sealed unit, and you can't take the data out of the country. China's a great example. And so the data's in the country, you're not allowed to take data out of the country.
I think I would just add to that, as I said, post-financial crisis, everybody was broadly aligned on what needed to be done and how you were going to do it. In practice, there's actually quite a lot of divergence in terms of how that's been implemented.
Yep.
But the kind of conceptually what we're trying to achieve was and I think still remains relatively kind of commonly held views. If you think about data, there are massively different philosophies underpinning things like privacy. So the approach in China versus the approach in Germany versus the approach in the UK versus the approach in the US all have a different underpinning. So if we talked earlier about the importance of trying to understand the sort of regulatory intent, the outcome you're trying to achieve, actually these are regulations that are trying to achieve diametrically opposed outcomes at times. And that means that when you're managing that system internally, you have got to be thinking not just about, as Stephen put it, a black letter divergence of the law, but actually what is the outcome we're trying to achieve here, because it's different. And there was a long period of time where we were trying to harmonize everything and trying to use the same systems globally and all of those good things to tidy up our messy legacy estates and all that sort of stuff. And part of what's happening now is unpicking some of that, because actually you do need different systems in different parts of the world, because you've got very different requirements for how they're going to operate. So it's definitely getting more complex, and will stay so.
I think both of you would say you cannot foresee ever there being a centralized global regulator.
Absolutely not.
Absolutely not. There are a few things I'm willing to bet on, but I think I'd probably bet on that one.
Death, taxes, no centralized global regulator.
A bit like that.
And I think the reality is there was never ever going to be a global regulator. The closest we got to anything like that was the work that was being done by the FSB and BCBS post-crisis. But even then, all you can hope for is some sort of harmonization of standards, degrees of regulatory recognition or regulatory deference from one regulator to another. We, again, this will probably be cyclical. We had a high point of that a few years ago. We're definitely moving down towards a low point in that space. That doesn't mean we might not come up again. And I think a lot of the discussion on AI, on cyber and so on is focused on, these are global problems. How do you solve them without having a global approach? So I think we may find that we start to see some more regulatory convergence in the future, but I don't think we'll ever have a single regulator.
One of the things that I've seen over the last couple of years, working with a variety of firms and looking at, for instance, at their training modes and at their policy modes, is that they are sort of self-selecting global standards. What I mean by that is there's a couple of global firms I can think of who have just decided that in terms of data, for instance, the really high watermark is GDPR in the European Union. And they've kind of almost explicitly just adopted GDPR everywhere that they are. In the same way that a few years before that, another firm just basically took the UK approach to fraud, because it was the highest watermark in fraud. Right. So they just kind of applied it everywhere, because that's the highest hurdle we have to jump. We're just going to jump that everywhere. One. So, and, you know, I would say that we're getting to a stage where from the European Union, DORA is approaching that kind of, oh gosh, well, we've got, 15 branches in Europe. We're just going to apply that to all of our supply chain management because it's the highest hurdle we have to jump. So it's not regulatory convergence and it's not a single regulator, but it's firms adapting to the realpolitik of big jurisdictions setting high standards and saying, well, okay, we'll choose the highest hurdle. And it used to be the case, 30 years ago, that all of those most difficult tests came out of the US. Things like 15A6 and all those things we used to have to do. And now they're not the sole or even the prime originator of the key global hurdle, and they're coming from different places. But firms are choosing their own hurdle.
I think we should do the fingers on buzzers round.
I thought that was it. I thought we'd had that.
So I've got some questions here.
Okay.
Buzz in, or just start to vibrate when you think you know the right answer. In 2026, what is more dangerous, moving too slowly on regulation or moving too confidently in the wrong direction?
Moving too confidently in the wrong direction.
I agree.
Oh, good.
Good, 1 point. If regulators knock tomorrow, what's the one area most firms couldn't evidence properly?
Record keeping.
Yeah.
You'd agree?
Yeah, definitely.
So 1-1. Okay, this is good. This is going to be close. Will AI create more regulatory risk or expose the risk that was already there?
I think it will expose more risk.
Because
it will give us better ways of interrogating greater quantities of data.
I think that's probably.
But I think we also have to note that it will create a whole bunch of stuff that at the moment we're not accounting for.
We didn't know about. Absolutely. Okay, here's one that touches on something we were talking about earlier. Is human in the loop becoming a safeguard or a comfort blanket?
It's being used as a term that gives us a comfort blanket. I don't know we've thought through sufficiently how it is properly used as a safeguard.
Good answer. What will be the bigger failure in 2026? Missing misconduct or missing the early warning signs of the misconduct?
So I could answer this in two ways. In a practical, real-world way, missing misconduct is the bigger risk. In a sort of philosophical, how would we like the industry to evolve? It's definitely missing the warning signs of misconduct, because the latter's proactive, the first is reactive.
It's the perfect answer. 2 points.
Oh, yes, that was...
Are firms over-investing in controls and under-investing in culture?
Yes. I think.
Yeah. Fair enough. Yeah. It was a fast enough answer to say you're probably right. Does compliance still say no too often or not early enough?
I think you're asking two compliance officers that question. Of course, we don't ever say no, except when it's entirely appropriate to say no.
Hema Lomax would disagree with you.
No. I think the question of involving people early enough is really critical.
Yeah.
How do you kind of get engaged in that conversation at a time when you can influence the outcome? A really successful compliance officer will never end up having to say no, because there will never be a proposition put in front of them that is completely unacceptable, whether that's because culturally people won't ask for nonsense, or because you've been involved and you've been able to shape the proposition on the way through to make sure it works from a compliance and an ethical perspective. That's in the ideal world. Obviously in the real world you will be saying no quite a lot because people haven't done their work or haven't done their due diligence.
I'll do my sympathy for the devil piece, which is that I fear, we were talking earlier about the rate of change and the difficulty of compliance and risk people of hanging on to and putting their arms around the rate of change. There is a risk that embattled compliance officers will actually say no more often because it's easier than trying to stop the flow for a moment and really understand what's going on. I don't think good compliance officers ever set out to do that, but there are, kind of accidental corollaries of the rate of change and the rate of flow. It may push people in the direction we don't want.
Is compliance actually preventing misconduct, or is it just documenting it better after the fact? Tiebreaker. It's a big question.
I think it's a bit like the question about the French Revolution and its effect. It's too early to know. Sorry, that was unhelpful.
It's a great answer.
I think if we think about compliance as just something which is there to prevent misconduct, we're already going off down the wrong track. The idea of, one of the challenges we have, I think, in the industry is that compliance has become a part of a machine which is designed to meet regulatory requirements, as opposed to being the part of the machine that helps manage your business better by understanding the risks and delivering the right outcomes for customers and for markets and so on. So I think I'm going to challenge the framing of the question about prevention of misconduct as being the kind of key role. I think actually the role of compliance is to drive good, sustainable business over the long term.
Thank you very much. So that's going to be a photo finish steward's inquiry, I think.
I'm prepared to concede on this one. If only because Tracey gave me the thinking time there to say that the ideal compliance department is one that no longer exists, because your controls can be fully integrated into just the way in which you do business. Now, I don't actually think that's going to happen because we're dealing with human behaviour, human output, human systems, all of those things. But the natural extension of what Tracey was saying would be a situation in which compliance is compliance with a small c as a set of behaviours and controls is so fully integrated into the way you do business that the idea of a compliance officer having to come round and say yes or no would be antiquated and redundant.
Brilliant. Tracey, Stephen, thank you.
Thank you.
Thank you.